Welcome to the deep dive. Today we're tackling, well, a pretty complex story. We've got the Q3 2025 results for a major industrial player.
And it's more than just numbers. We're looking at strong operational performance, definitely.
But against this backdrop of just massive multi-billion-dollar legal settlements, historic stuff, really.
Exactly. So for you listening, our goal is to get past the headlines. We want to understand the real drivers, what's working operationally.
And then face those huge legal issues head on, see how they connect.
The strategic shifts, the balance sheet impact, it's all intertwined.
Okay, let's get into it. Q3 2025 financials, balancing that execution strength with these legacy costs. Where do we start?
Right. And important to remember, we're mostly talking adjusted numbers here, non-GAAP. So this is meant to show the core business without those big one-off legal hits.
Correct. It gives you a clearer picture of the underlying operational health.
So hitting the high notes first, what did Q3 look like on that adjusted basis?
Well, it was pretty solid. Total sales hit $6.318 billion.
Which is up 4.1% from the same quarter last year. And maybe more importantly, the organic sales growth, that's growth without acquisitions, was a positive 3.2%.
4% top line is decent, but the margin figure, that really caught my eye.
It did. Adjusted operating margin reached 24.7%.
Wow.
Yeah, that's a jump of 170 basis points year over year. For perspective, that's a 1.7 percentage point increase in how much profit they make on each dollar of sales. Pretty significant at this scale.
Definitely. And the bottom line, adjusted earnings per share, EPS.
Came in at $2.19. That's a solid 10% increase from last year's $1.98.
And they called that out specifically, right? As beating expectation.
They did. Said it outperformed expectations.
Yeah.
Driven, they said, by commercial excellence and, importantly, new product introductions, NPIs.
Okay, so let's unpack that 10% jump. Where did the extra dollar for 21 cents per share actually come from?
Right, so if you break it down, a hefty $1.25 came straight from operations growth and productivity improvements. Good stuff. They also got a large 7% boost from lower restructuring costs compared to last year. But those gains were offset a bit. $0.07 went back into higher investments in the business, and there was $0.04 headwind from, let's call it, non-operational stuff, mostly foreign exchange effects. So, the core engine ran well.
And geographically?
Yeah.
Was the growth spread evenly around the world?
Not quite. China was the standout, showing high single-digit growth, HSD. That's encouraging for global demand. Meanwhile, the U.S. and the EMEA region, Europe, Middle East, Africa, both saw low single-digit, or LSD, growth. So industrial demand is picking up, but maybe a bit slower in those established Western markets.
Yeah.
Now, to really get a feel for the quarter, you have to look at the different business segments. And the story is, well, strength in the core industrial areas.
Which they really need, given everything else going on.
Absolutely. That's generating the cash.
So let's start with safety and industrial, S&I. That's their traditional powerhouse, right?
It really is. And it delivered this quarter. Sales were almost $3 billion, $2.91 billion to be exact. That's 4.1% organic growth.
And what drove that?
It was pretty broad-based. Strong demand in electrical markets, industrial tapes and adhesives, personal safety equipment, abrasives, all performed well.
And the margin there was incredible, up 200 basis points from 24.3% to 26.3%.
Just phenomenal margin expansion in S&I.
Were there any weak spots in that segment?
Yeah, a couple. The auto aftermarket continues to be a bit challenged. That's not a huge surprise given consumer spending. And they also noted some emerging softness in roofing granules.
Okay.
But overall, S&I was really fiery on all cylinders, driven by that industrial demand.
All right, let's move to transportation and electronics. T&E. This one's tied more to tech cycles and, well, things that move.
Right. T&E brought in just under $2 billion, $1.992 billion in sales. Organic growth there was 3.6%.
Also solid. Key drivers.
The electronics was a big one.
Yeah.
Especially components feeding into the semiconductor industry. Also, transportation safety products, advanced materials, and aerospace was very strong, double-digit growth there.
Okay, double-digit aerospace is great, but the overall T&E margin was basically flat year over year. It dipped slightly, 24.5% down to 24.3%. Why wasn't it stronger with those drivers?
Yeah, good question. Two main things holding it back, really. First, the broader auto sector, particularly commercial vehicles, remained weak. Auto OEM was flat, but commercial dragged. But the probably bigger impact here is this is the segment really feeling the heat from the planned exit of manufactured PFAS product.
Oh, right, the strategic exit.
Exactly. That's a massive operational shift. It creates cost headwinds, dyssynergies, as they call them. That's definitely weighing on T&E margins right now.
Makes sense. Okay, lastly, the consumer segment, home of the sticky notes and filters. very exposed to consumer spending habits.
And you saw that exposure this quarter. Sales were $1.312 billion, but organic growth, just 0.3%, basically flat.
Oof.
Yeah. Now, some key brands did well. Filtrete filters, Scotch tape, McGuire's car care stuff. Those showed some strength.
But overall,
Overall, it was just subdued consumer discretionary spending, holding things back. People being cautious.
okay, wait. If sales were flat, 0.3% growth, how do they manage to boost the consumer operating margin from 20.2% all the way up to 22.2%? That's a huge 200 basis point jump.
Right. It's pretty impressive. And it tells you exactly what the focus is internally. Productivity, cost control, efficiency programs. They are squeezing more profit out of each dollar of sales, even when the top line isn't growing much. New products probably help with pricing in some areas too, but fundamentally that margin jump is about operational discipline winning out against a soft market.
Okay, so that's the operational side. Pretty strong, good execution, managing costs. But now we have to wade into the legal swamp.
Yeah, this is the other side of the coin, the massive liabilities.
We need to connect those solid operating profits to these just staggering legal costs from past products.
It's the company's dual reality. And there are two main buckets we need to talk about, PFAS liabilities and the combat arms earplugs, or CAE, litigation.
Let's start with PFAS. Per and polyfluoroalkyl substances. The forever chemicals. They're exiting manufacturing these by the end of 2025. What's the price tag on the balance sheet for that?
It is eye-watering. As of the end of September 2025, they had recorded $7.5 billion in total liabilities, specifically tagged as other environmental liabilities.
$7.5 billion.
And the sources make it clear this is primarily, almost entirely, PFAS-related stuff.
How's that broken down, near-term versus long-term?
About $2.7 billion is current, so expected within the next year. The remaining $6.8 billion is long-term liabilities.
And that $7.5 billion isn't a fixed number, is it? It's still going up.
That's right. It actually increased by roughly $700 million just in the first 9 months of 2025.
Wow. What drove that increase?
Mostly two things. A settlement reached in New Jersey, and significantly, the interest accruing on that huge public water supplier settlement, the PWS settlement.
Right. The PWS one is enormous.
It is. And the payments for that stretch out over a very long time, from 2024 all the way through 2036. Think about that's a decade-plus commitment just for that one settlement.
And even with these massive settlements in place, there's still other PFAS litigation ongoing.
Oh, absolutely. It's far from over. You've still got lawsuits from various state attorneys general, Illinois, Vermont, Maine are mentioned, plus major class actions like the AFFF, firefighting foam litigation. It's complex.
Okay, switching gears to the other big one, the combat arms earplugs settlement. That was agreed back in August 2023. What liability are they carrying for that now?
Well, looking specifically at respirator mask and asbestos liabilities, but excluding the specific aero part of the earplug issue, that accrual stood at $471 million at the end of Q3.
$471 million.
And that number reflects estimated future claims expected all the way out to the year 2050.
25 years of claims baked in.
Yeah. And then separately, the aero-related product liabilities and defense costs add another $53 million to the accrual.
Just incredible long-term financial commitments. But there's a bit of an offset, right? Insurance?
Yes, and that's a really important financial lever for them. Insurance recoveries.
How much did that help this quarter?
In Q3 2025 alone, they recorded $182 million in benefits from insurance recoveries.
Okay.
And that cash is directly linked to offsetting costs for the respirator asbestos issues, the CAE settlement, and PFAS matters. It's a significant chunk of cash flow support each quarter. So beyond the day-to-day operations and these huge liabilities, we also need to look at how they're actively managing their overall business portfolio, shaping the company for the future, partly to handle these costs.
Right. And the biggest move there recently was spinning off the healthcare business into Solventum.
That's the major one. The separation happened back in April 2024. But what's key now is that the company still owns about 15% of Solventum stock.
And that's worth?
As of the end of Q3 2025, that stake was valued at roughly $1.9 billion.
Almost $2 billion.
Yeah. And they've stated their intention is to sell off that entire stake within the next 5 years. So that $1.9 billion represents a pretty significant source of future financial flexibility or, well, cash.
And are they trimming other parts of the remaining business too?
Seems like it. The Q3 report mentioned a write-down related to a smaller business, something in precision grinding and finishing, which they've now classified as held for sale.
Okay, so continued optimization.
Yeah, focusing on that industrial core.
So, given the strong quarter operationally, despite all the complexities, how are they feeling about the full year 2025? Did they update their guidance?
They did. Based on the performance so far, they bumped up their full-year forecast. They're now projecting adjusted EPS in the range of $7.95 to $8.05.
And cash flow, that seems critical here.
Absolutely critical, and the picture looks good there. Adjusted operating cash flow is projected between $5.2 and $5.4 billion for the full,
Which translates to?
which translates to greater than 100% adjusted free cash flow conversion, meaning they expect to convert more than every dollar of adjusted net income into actual free cash flow.
That's very strong. Especially with those settlement payments needing funding. What headwinds did they mention that could potentially derail that guidance?
Well, you have the usual global company stuff, unpredictable foreign currency swings, tariffs. Those always factors.
Sure.
But they also specifically called out those lingering cost dyssynergies, the ones related to, one, the complex operational exit from PFAS manufacturing, and two, the structural adjustments needed after spinning off Solventum.
Right. Restructuring costs money, even if the underlying business is doing well.
Exactly. It takes time and investment to fully realize the benefits of those big strategic moves. Hashtag tag outro.
So let's try to wrap this up. What does this all mean for you, the listener? We've seen a company putting up really solid operational numbers, good growth, impressive margin expansion, particularly in industrial.
Demonstrating strong commercial execution, no doubt. Productivity gains are clear, especially in consumer.
But all of this strength is fundamentally needed to shoulder these billions and billions of dollars in environmental and legal liabilities, costs that stretch out not just years, but decades into the future.
Yeah, that's the core tension. You see the operational engine running well, expanding margins almost across the board, but then you see the scale of the financial commitments from the past. That $7.5 billion PFAS accrual, the PWS payments running until 2036.
It just dictates so much of their financial strategy.
It has to. The updated guidance shows confidence, sure. They believe they can keep generating profits and, crucially, cash.
But for you listening, the real drama to watch moving forward is how they manage the timing. The timing of using their big financial levers like that Solventum stock against the fixed schedule of those massive settlement payments.
Which leads us perfectly into our final provocative thought for you to mull over. We know they plan to sell that remaining $1.9 billion stake in Solventum within 5 years.
Right. But they also have these very large certain cash payments due for the settlements, particularly the PWS one, every single year between now and 2036. So here's the question. What pressure does that put on their timing for selling the Solventum stock? Do they try to maximize the value over 5 years? Or could the near-term need for settlement cash force them to sell sooner, potentially at a less optimal price? How do they balance long-term value versus immediate liquidity needs?